Welcome to ETF Investing. Today we're tackling a key question: what exactly is an ETF? In simplest terms, ETF stands for Exchange Traded Fund. Now let's break that down. Exchange traded means it's bought and sold on a stock exchange, just like individual stocks. Fund indicates that it's a pooled investment vehicle, similar to a mutual fund. So an ETF combines aspects of both stocks and mutual funds. Here's the basic idea. An ETF holds assets such as stocks, bonds, or commodities, and its shares are traded on stock exchanges. This means you can buy or sell shares in an ETF, just like you would with a regular stock. The beauty of an ETF is that it gives you a way to invest in a diversified portfolio without having to buy each component individually. So in essence, an ETF is a type of investment fund and exchange-traded product, traded on stock exchanges. Clear as mud? Don't worry, we'll dive deeper as we go along. Now that we know what an ETF is, how does it compare to other investment options? Let's dive right in. First, consider mutual funds. Like ETFs, they pool investors' money to buy a diversified mix of assets. However, ETFs are traded on an exchange like stocks, meaning you can buy and sell them throughout the day at fluctuating prices. Mutual funds, on the other hand, are only priced at the close of the trading day. Speaking of stocks, while they offer potential high returns and direct ownership in a company, they lack the built-in diversification of ETFs. With ETFs, you're spreading risk across a basket of stocks, not putting all your eggs in one corporate basket. Then there are bonds, known for their income generation and lower risk. But unlike bond ETFs, individual bonds can lack liquidity, making them harder to sell. As you can see, ETFs offer a unique blend of features that set them apart from other investment options. Let's get under the hood and see how an ETF operates. Imagine an ETF as a giant basket. This basket holds various assets like stocks, bonds, or commodities. It's created by large institutional investors, known as authorized participants, who fill this basket with the desired assets to form what we call a creation unit. Now, this creation unit is not for direct sale. Instead, it's broken down into shares, which are then bought and sold on the stock exchange. Much like individual stocks, this is where you, the individual investor, come in. You can buy as many or as few of these shares as you want, giving you a slice of that diverse asset basket. But what happens when you want to sell? Well, the process reverses. The shares are bundled back up into creation units and returned to the authorized participant, who then disassembles the basket and sells the individual assets. And that's how ETFs work, from creation to redemption. Simple, right? Time for some real-world examples of ETFs. Let's start with the Spider S&P 500 ETF. This ETF mimics the performance of the S&P 500, a broad market index representing 500 of the largest companies in the US. By investing in this ETF, you essentially own a tiny piece of each of those companies, diversifying your holdings and spreading your risk. Next, consider the Invesco QQQ ETF. This fund tracks the NASDAQ 100 index, which consists primarily of technology companies. If you're bullish on the tech sector, this could be an interesting option for you. For those interested in international exposure, the Vanguard FTSE Emerging Markets ETF offers a diversified portfolio of stocks from emerging markets around the world. Lastly, let's look at a thematic ETF. The Global X Robotics and AMP Artificial Intelligence ETF focuses on companies in the robotics and artificial intelligence sector. These examples give you a glimpse of the versatility of ETFs in an investment strategy. Like any investment, ETFs come with both advantages and risks. One of the most notable perks of ETFs is their liquidity. Unlike mutual funds that are only traded at the end of the day, ETFs can be bought and sold throughout the trading day, just like individual stocks. This allows for greater flexibility in response to market changes. Another advantage is cost efficiency. ETFs typically have lower expense ratios compared to mutual funds, which means more of your money goes towards your investment, not fees. However, it's not all sunshine and rainbows. ETFs also carry risks. Market risk is a big one, as the performance of an ETF is tied to the performance of the underlying assets. If those assets perform poorly, so does the ETF. There's also the risk of closure. If an ETF doesn't attract enough investors, it may close, potentially leaving you with unexpected tax implications. Understanding these pros and cons will empower you to make informed decisions in your ETF investment journey. Ready to become an ETF expert? No? Well, this is certainly a good first step. I hope this video has helped you in answering the question of what an ETF is. We will be posting more videos to dive deeper into the workings of ETFs. So, hit that subscribe button, ring the notification bell, and join us on this investing journey. Knowledge is the key to confident investing. See you in the next video. Until next time,